So as we just heard, the U.S. Federal Reserve has approved its third rate cut of the year, capping off a rough year for central bank officials as they battle inflation and a weakening labor market. For more on this, we're joined today by Greg Buchak, professor of finance at Stanford Graduate School of Business at Stanford University. Professor Buchak, thanks for joining us today.
Thanks for having me.
So the Fed has been sharply divided over cutting interest rates. What led to this decision today, and what's your take on the rate cut?
Sure. So kind of overall, the core trade-off for the Fed is that lowering rates encourages spending and investment, and eventually that kind of filters down to the labor market. But that also risks overheating the economy and leading to inflation. So kind of in the background, there's this trade-off that's animating the Fed's decision-making. Now, right now, if you look in the data, the unemployment rate is quite low, but the direction of the latest data is worrying, which suggests some softening in the labor market, and that kind of calls for lowering rates. On the other hand, inflation is still around 3% year over year. That's significantly higher than the Fed's 2% target, and that would call for keeping rates steady. So in the end, kind of concerns around the labor market won out in the FOMC and the Fed lowered rates. So no real surprises here. This is kind of widely expected in the market. I think the more notable thing that happened today was the amount of dissent and disagreement among the FOMC members and sort of questions about what's going to happen going forward.
Right, and this was the Fed's third straight rate cut, and central bank officials projected just one rate cut for next year. What's your outlook for 2026 in terms of future rate cuts?
Yeah, so it's really going to depend on how the inflation and unemployment situation evolves going forward, and there's actually a lot of internal disagreement within the Fed too. The inflation rate in the U.S. is down from its peak. It has remained stubbornly elevated relative to the target, and the concern is sort of more accommodative monetary policy will keep inflation at its current level or even let it drift higher. So as your report noted, there were three dissenters in the FOMC, which is kind of unusual. One, who's a close ally of Trump, wanted steeper rate cuts, while two wanted to hold rates steady. And that kind of internal disagreement really underscores the uncertainty around the decision-making at the Fed. The Fed, when they released their rate decision, they also released something called the dot plot, which asks each FOMC member whether he or she expects the policy rate to be where they expect it to be in the future. And the responses for 2026, they ran between 2% and 4%, actually higher than the current rate. That's quite a broad range, again, kind of reflecting this significant uncertainty. Now, markets, for what it's worth, they're pricing in one or two further cuts. That's, I think, a reasonable midpoint, but the range of outcomes could be quite wide depending on the data that comes in.
I see. So the federal funds rate is now at its lowest level in more than 3 years now. How might this sort of affect global markets?
Sure. So Fed rate cuts propagate globally in a few ways. So kind of like the basic thing is higher U.S. spending and investment. That typically raises demand for foreign goods. That supports global growth. It also transmits some inflationary pressure abroad. So sort of for better or for worse, a rising tide lifts all boats. On the FX market, lower U.S. interest rates, they reduce the value of the dollar relative to other currencies. Now, the intuition for that is, if Australian bonds pay a higher rate than U.S. bonds, I want to convert some of my dollars into Australian dollars, and that's going to sort of change the relative valuation of those currencies. Same idea on the margin for all currencies. Now, if the U.S. dollar depreciates, that tends to make U.S. exports and domestic goods more competitive relative to foreign goods. So this puts a little bit of pressure on foreign exporters. And then, as you mentioned, is the case for the Bank of Korea, but this is also sort of generally true. A lot of non-U.S. central banks, they sort of keep their rates moving with U.S. rates. So they often view the kind of U.S. rates as a major driver or often kind of a constraint in their own decision making. So you'll expect this to see sort of percolating across the globe there.
Right, and on inflation, President Donald Trump said he plans to focus on combating inflation while he was in Pennsylvania yesterday. Have tariffs affected inflation, and do you think the administration will be able to ease the public anger over the rising cost of living in the coming year?
Yeah, so tariffs are inflationary. They increase the costs for consumers and businesses, especially when they're on input goods. And so, again, for people who support tariffs, that's kind of the whole logic. If the goal is to help U.S. domestic industries by making foreign imports more expensive, then prices have to rise for that to work. Now, consumers hate that. So inflation during Biden's presidency was a major issue that led to Trump's 2024 victory. Voters really care about inflation, but a lot of Trump's policies have sort of not really been consistent with that concern. Now, if you're the Fed, that puts you in a very difficult position. So in fighting inflation, they're kind of fighting this uphill battle against Trump's trade policy. But then on the employment side, policy uncertainty around tariffs, around immigration, they really hamper kind of business investment. So as I'm sure you're aware, there was this immigration raid on Korean workers in a Hyundai plant in Georgia. That's a great example. It's very hard for businesses to invest in America, create jobs kind of in the face of that policy uncertainty. So sort of overall, it's not an easy time to be at the Fed.
I see. I guess we'll have to see how that goes. All right, Professor Buchak, thank you so much for your time today. We appreciate it.
Thanks for having me.